Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Amazon.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. For a company of this size, what we're seeing in the latest reports isn't just growth. It's really a story of powerful, accelerating efficiency that's kind of hidden just beneath the surface.
That is the perfect way to frame this, because when you look at the top line, the revenue, it's just incredibly robust.
So consistent.
Yeah, we're talking about a genuine double-digit growth engine, which at this scale is phenomenal. In Q2 of 2025, net sales were up 13% year over year to, $167.7 billion.
And that momentum just carried right through.
It did. It held steady into Q3, where they hit $180.2 billion, maintaining that same 13% increase.
But the key indicator for me, and I think for a lot of people, is the organic growth.
Yeah.
You have to strip out the currency effects.
Right.
And when you do that, you're still looking at 12% growth in both of those quarters. That
Wow.
tells you it's real underlying demand, not just, a weak dollar helping them out.
And in the heart of that, the real engine is still undeniably the North America segment. The scale there is just, it's hard to wrap your head around.
$106 billion in Q3 alone.
Exactly. But, revenue is one thing. Making money from that revenue, that's the whole other side of the coin.
And that's where the story gets really compelling.
Yeah.
Because for years, the narrative was just growth at any cost.
Spend, spend, spend.
Right. Now we are seeing real operational leverage finally kicking in. The operating income for that North America segment surged to $5.8 billion in Q1 2025.
And just for context, that's a big jump from the $5 billion they did in Q1 of the prior year.
It is, and that growth in operating income is the crucial takeaway here. It shows that all those massive investments in fulfillment, in warehouses, in logistics, they're finally hitting that point of scale.
Economies of scale.
That's it. Think of it this way. Every new dollar of sales now costs them less in overhead than the last one did. They've built the infrastructure, and now the volume is just driving profit straight to the bottom line.
Shows a mature, highly efficient business, not just a money burner anymore.
Okay, so if that's compelling, this is where the story gets really interesting. We have to talk about the normalized profitability.
This is arguably the biggest insight for anyone looking at Amazon right now.
It's the difference between the reported number and what's actually happening structurally. So first, we saw operating income jump to $18.4 billion in Q1, a strong number.
But then Q3 comes along and the reported number drops a little bit to $17.4 billion.
Right.
And if you just look at that, you might think, oh, okay, things are plateauing.
But you absolutely cannot take that figure at face value. It was masked by these significant one-time charges that have nothing to do with the core business performance.
So you have to strip those out to see the real picture.
Exactly. The two big ones were, $2.5 billion for that FTC legal settlement?
Which, okay, it's painful, but it resolved a huge headache for them.
A huge regulatory headache, yeah.
Yeah.
And then there was another $1.8 billion in severance costs, which is, tied to their efficiency push, layoffs and right-sizing.
So if you do the math, if you take those non-recurring items out, the whole narrative flips.
Completely. The true normalized operating income for Q3 wasn't $17.4 billion. It rockets up to $21.7 billion.
That $4.3 billion difference is everything. It shows the business is performing way better than the headlines would have you believe.
It's a powerful signal. Management's focus on cost control. It's not just talk. It's really translating into profit.
And when you have an underlying number that high, it makes their forward guidance look,
almost intentionally conservative.
Right. They guided Q4 operating income to land somewhere between $21 and $26 billion. The prior year was $21.2 billion.
So on paper, it looks flat to modest, but they always underpromise. The midpoint there is $23.5 billion, which still implies confidence.
Yeah. And given that the underlying Q3 hit almost $22 billion, there's a lot of room to beat expectations in the big holiday quarter.
A lot of room.
Okay, so let's pivot a bit. Let's talk about what defends all this profitability. It's not just size, it's this durable competitive defense system.
The triple moat.
Exactly. These three ecosystems, e-commerce, AWS, and data AI, they all reinforce each other and create these incredibly high switching costs for customers.
So the first moat is obvious, right? E-commerce dominance. The logistics and fulfillment scale is it's unparalleled. Competitors can't replicate it without burning billions and billions of dollars.
It's a classic network effect. More sellers means more selection, which means more buyers, and on and on.
Then you have the second moat, which is probably the most critical for the valuation. That's AWS.
Market leadership. We're talking about, what, a 32% share of the global cloud market?
Roughly, yeah. And being the first mover gave them this huge advantage. Enterprise customers are deeply locked in. Moving a whole corporate system out of AWS is, well, it's a nightmare. It's prohibitively expensive.
And the third moat, which is becoming the most strategic one, that's data and AI.
The sheer volume of data they have is just a colossal advantage. Decades of retail habits, Prime Video viewing, AWS usage.
Which leads us straight into how they're deploying their capital. AWS is still the cash flow engine.
Absolutely. $30.9 billion in trailing 12-month sales with 17% growth. That consistent cash flow lets them make these massive strategic bets.
And the biggest bet right now is obviously the AI frontier.
I mean, that $9.5 billion pre-tax gain they realized from their investment in Anthropic in Q3, that's not a small exploratory bet.
No, that's a high conviction move. It signals they see this as absolutely foundational to their future.
It positions them as a critical infrastructure player in the whole AI arms race. They aren't just building models, they're enabling everyone else to build models on their platform.
And they have the dry powder to keep doing it.
That's the key. The balance sheet is so strong, $71.7 billion in cash as of Q2. That kind of liquidity gives you tremendous flexibility to make these multi-billion-dollar long-term plays without stressing the business.
Okay, so we've covered the growth, the efficiency, the moats, but we have to address the risks. What's the biggest challenge they're facing right now?
It is, without a doubt, the AWS margin headwind. This is the central debate for investors.
Right. We saw AWS operating margin compress from a high of, what, almost 40%?
From 39.5% all the way down to 32.9%. That's a huge decline, a 660 basis point drop.
And this is where the bull case and the bear case really diverge. Is this temporary because they're investing heavily in AI infrastructure, buying expensive GPUs and building data centers?
Or is it structural? Is it a sign that competition is finally catching up and eating into their pricing power?
The bullish view, which I think the evidence supports, is that this is a growth investment compression.
I agree. You have to buy the chips and build the capacity before the customers can use it. The costs come first. As those new data centers fill up, the margin should naturally expand again.
And the fact that AWS growth is still at 17% suggests they aren't losing pricing power. If they were, you'd see that growth rate start to collapse.
Exactly. They're just paying up front to meet what they see as explosive future demand for enterprise AI.
And we shouldn't forget the risk that they actually mitigated recently.
On the regulatory side, you mean?
Yeah, that $2.5 billion FTC settlement charge. It's a big number, but it effectively closes the book on one major regulatory fight.
It removes an overhang. It frees up management's time and resources to focus back on growth.
So looking ahead, what are the immediate catalysts?
Well, the Q3 results themselves were a huge catalyst. That net income beat was spectacular, $21.2 billion, up 38% year over year. That's massive earnings acceleration.
But the next big event on the calendar is the Q4 earnings release. That'll be late January 2026.
And that's the moment of truth. That's when we get the crucial 2026 guidance. We'll see if the AWS growth trajectory is holding up, if margins are stabilizing.
And critically, we'll start to see how they plan to monetize all this expensive AI infrastructure they've been building. The market will want proof that the spending is going to translate into revenue.
It's going to be a pivotal report.
So to bring it all together, the investment case here seems to rest on a few really powerful pillars.
I'd say so.
First, you have that accelerating underlying profitability, which we see in that normalized Q3 number of $21.7 billion.
And second, you have strategic dominance in two completely massive, distinct areas: global e-commerce and now being the core infrastructure provider for the AI revolution.
The combination is potent. They've navigated that post-pandemic slowdown and are now running a much more disciplined, profitable playbook.
Right, and they're capitalizing on this huge boom in enterprise AI spending, which that Anthropic investment proves. For anyone looking out, 12 to 18 months into 2026, the earnings story and the deepening moats made this a very compelling situation.
So it seems like a good idea to accumulate shares heading into that Q4 report. But here's the final thought I want to leave you with. If Amazon has finally mastered operational leverage in retail, if they've achieved this sustained high level of profitability, what does that mean for everyone else? Does this new efficiency force a permanent deflationary pressure on all their competitors? Does it fundamentally shift how everything is bought and sold online? That's the long game they're playing.
A fascinating question. And that wraps up our analysis for today. If you found our talks useful, please remember to subscribe, like, and comment underneath to support our work.